Welcome to 3 and 3. My name is Jason Weaver. Today we're going to be talking about Fed policy, inflation components, and asset class correlation. So Fed policy. The Fed has been the primary driver of asset prices in 2019. The basic mandate of the Fed is the price stability measured in inflation and also full employment. So what's going on with the Fed? If we look back to July of 2018, the economy was doing very well and inflation was moving up to about 2.5% to 3% by October, and the Fed was talking about raising interest rates 2 to 3 more times. Fast forward now, we're in July of 2019, and the stock market is pricing a 100% probability of a rate cut of 25 basis points and a 65% probability of 50 basis points and 2 to 3 more rate cuts by the end of this year. So what the Fed is trying to do is they're trying to reflate asset prices. If you look back again to December of 2018, the stock market fell on its face again as interest rates were moving up. And now they're trying to reflate again stock prices by reducing interest rates. So the inflation components that are allowing the Fed to do this have actually started to moderate. And that is again the price of goods and services. So as we look at those goods and services, and again this is a pretty busy chart, we're looking at the components of inflation. So you have food and beverage, which is running about 2%. You have in housing, which is hurting those renters. That's where the greatest increase is actually coming from, and that's 42% of inflation. Energy has actually been pretty negative to inflation, and medical has actually been running at about 2%. So we look at headline CPI and core CPI. Headline CPI looks at all of these together, and core CPI strips out energy and food, which are the more volatile components of inflation. So asset class correlation. So as the Fed has actually been talking about lowering interest rates, and we look at the main asset classes of equities, bonds, alternatives, and cash, you'll see there's been a tremendous correlation between those two, or four. So if you're invested in the S&P and you compare it to the S&P, the correlation is then, again, 1. If you're looking at the S&P and comparing it to the U.S. Aggregate Bond Index, the correlation is actually negative. And commodities have a 0.38 correlation, and cash has a very low correlation. So looking into 2019, you can see all of those actual asset classes are up. Stocks are up 20%, bonds are up 5.87%, commodities are up 7.52%, and cash is up 1.14%. So by allowing the Fed to actually reflate asset classes, they're hoping to get inflation back and the economy going in the right direction again. Thank you again for joining us for 3 and 3.